All right, let's break down Beacon Financial's Q4 2025 earnings call. Now, this is a big one because it's their very first full quarter of results since the merger. So this isn't just another report. It's really the market's first real hard look at how this new combined bank is actually delivering on all those promises they made.
And that brings us to the central puzzle of the day, right? The company beat on their earnings per share, but they actually missed on revenue. Usually, that's a recipe for a pretty mixed, maybe even negative reaction from the market. So the big question is, why did Beacon's stock jump over 2.5%? That's exactly what we're going to unpack.
Okay, let's dive right in by looking at the numbers themselves, the conflicting signals that created this whole puzzle in the first place. So, on the one hand, you've got operating EPS, earnings per share, coming in at 79 cents. That's a penny ahead of what Wall Street was expecting. A solid beat. But then you look at the other side, revenue, $225.66 million, which missed the consensus by over $3 million. That is your classic beat and miss scenario.
But here's the kicker. Despite that revenue miss, the market's verdict on January 29th was, well, it was decisive and it was positive. The stock closed up 2.66% and on higher than average volume too. The market clearly saw something else in this report that it liked a whole lot more than that top-line number.
So what was it? Well, the answer isn't in those headlines. It's buried deeper in the progress of the merger itself. You see, investors were hunting for clues that the whole reason for combining these two banks was sound, and management, well, they delivered a very confident message.
CEO Paul Perl really set the tone with this quote. I mean, this tells you everything you need to know about how they're thinking. They're not making excuses about revenue. No, they're pointing straight to the strategic execution and saying, hey, the plan is on track. And that is exactly what investors wanted to hear.
Now here's where it gets really interesting. They made a super savvy accounting move that just screams sophisticated balance sheet management. Beacon decided to early adopt a brand new accounting standard. And what this did was let them immediately boost their equity, their capital base, by $49 million. Now, what's the trade-off? Well, they give up between $10 to $13 million a year in future pre-tax income that was tied to the merger's accounting. So think about it. They're choosing to sacrifice a little bit of reported income down the road for a much stronger, cleaner balance sheet right now. The market loves to see that kind of thinking.
And this slide just perfectly lays out the path forward. The merger was announced just over a year ago. Now, the next huge milestone, the really heavy lifting, is the core systems conversion. That's happening in February. And once that's done, management expects to see the full financial benefits, all those synergies, start hitting the books in the second quarter. The timeline is crystal clear, and the biggest operational hurdle is right around the corner.
Okay, so let's shift gears and talk about the balance sheet strategy, because beyond just the mechanics of the merger, the market was really dialed in on the deliberate moves management is making to de-risk the bank and crank up that core profitability.
Management laid out three key pillars that really drove the story this quarter. First, expanding the net interest margin. That's basically the core profitability of a bank. Second, intentionally shrinking their exposure to commercial real estate, or CRE. And third, just optimizing their capital structure. I mean, these are the textbook signs of a really well-run bank.
And boy, are they delivering. Just look at this jump in net interest margin, or NIM as we call it. It expanded by 20 basis points in a single quarter, from 3.62% all the way up to 3.82%. In the world of banking, a 20 basis point jump in 3 months is a massive win and a huge driver of earnings that the market absolutely loved.
So let's put it all together. How did the market take all these different pieces, the good, the bad, and come to such a bullish conclusion?
Well, it pretty much boils down to this. The market saw that revenue miss and correctly chalked it up to merger accounting noise, which is always messy and hard to predict. Instead, they focused on that operating EPS beat, which showed that the underlying business is really profitable. But most importantly, it was the guidance. The message was clear. The merger is on track and core profit drivers like NIM are getting stronger. So the bottom line is, the market gave management huge points for credibility, and that credibility trumped everything else.
So where does Beacon go from here? Let's look ahead to the next earnings call and think about what could really drive the stock going forward. So for the first quarter of 2026, I'd say expect more noise. The reported GAAP earnings number is probably going to be messy because of all the final merger charges from that big February systems conversion. The smart money, though, they won't be looking at the headline number. They'll be laser-focused on what that synergy run rate looks like after the conversion and if they're still making good progress on shrinking that commercial real estate book.
The key catalysts for the stock price are pretty clear. First, they have to nail that systems conversion in February. It has to be flawless. That is non-negotiable. Second, the market's going to need to see the efficiency ratio improve, which is a key metric for banks, to confirm that those cost-saving targets are for real. And finally, you're going to want to listen really closely to what management says about deploying capital, especially if they talk about refinancing some expensive debt, which could be another nice boost to their bottom line.
So, based on all this, the strong execution, that clear path to realizing the merger benefits, and the really smart balance sheet management, our view on Beacon Financial is outperform. They are navigating a super complex merger really effectively, and it looks like building a much stronger, more profitable bank for the future.
And one last, very important note. This is not financial advice. This explainer is for informational and educational purposes only.